$50 a week. That's less than most people spend on coffee, less than a gym membership, less than a single dinner out. But what if I told you that $50 a week invested in one ETF could eventually pay you more than your current job? Not in some fantasy scenario, with real math, real numbers that you can verify yourself. Today, I'm breaking down exactly how $50 a week into SCHD builds into a dividend income machine. And I'm going to show you the exact numbers, year by year, you can see for yourself when this thing starts replacing your paycheck. Let's get into it. What is SCHD? Before we get to the math, let me quickly explain what SCHD actually is, because if you're newer to investing, this matters. SCHD stands for the Schwab U.S. Dividend Equity ETF. It was created by Charles Schwab, and it holds 100 of the strongest dividend-paying companies in America. We're talking companies like Coca-Cola, Verizon, Pfizer, Home Depot, businesses that have been paying and growing their dividends for years. Now, here's what makes SCHD different from just buying any dividend ETF. SCHD doesn't just look for high yield. It screens companies based on 4 things: cash flow to debt ratio, return on equity, dividend yield, 5-year dividend growth rate. In plain English, it only picks companies that are financially strong and have a track record of growing their dividends over time. And the result? SCHD has delivered roughly 11% average annual returns when you include dividends reinvested. It currently pays around a 3.5% dividend yield, and that dividend has grown consistently year after year. This isn't a flashy growth stock. It's not trying to make you rich overnight. It's a slow, boring, incredibly powerful compounding machine. And $50 a week is all it takes to start. The math breakdown. Okay, here's what you actually came for. Let's run the numbers. $50 a week equals $2,600 a year. I'm going to assume 11% average annual return, which is SCHD's historical average with dividends reinvested.
You reinvest every dividend you receive. This is called DRIP, Dividend Reinvestment Plan, and it's the secret weapon here. You never increase your contributions, just $50 a week, every week, no matter what. Let's see what happens. After 5 years, your portfolio is worth about $17,000. Your dividends are paying you around $50 a month. Small, but it started. After 10 years, $46,000 in your account, monthly dividend income around $134. You're getting a free tank of gas every month just for doing nothing. After 15 years, $98,000. Monthly income hits $286. That's a car payment coming in automatically every single month. After 20 years, $189,000. Monthly dividends of $551. That's groceries, phone bill, electric bill covered. After 25 years, $343,000. Monthly income over $1,000. We're talking $1,000 a month from $50 a week. And after 30 years, $603,000 in your portfolio. Monthly dividend income of $1,759. That's over $21,000 a year, coming in whether you work or not. Let me say that again. $50 a week, 30 years, $1,759 every single month in passive dividend income. Now, I know what some of you are thinking. 30 years feels like forever. But here's the thing. Those 30 years are going to pass whether you invest or not. The only question is what you'll have at the end of them. The job replacement moment. Now, let's talk about what replacing your job actually means, because I want to be real with you here. I'm not saying $50 a week will make you a millionaire in 5 years. That's not how this works. But here's a different way to think about it. What are your actual monthly expenses? For most people watching this, it's somewhere between $2,000 and $4,000 a month. Rent or mortgage, food, car, insurance, utilities, subscriptions. Let's say your number is $3,000 a month. At SCHD's 3.5% yield, you need a portfolio of about $1,028,000 to generate $3,000 a month in dividends. That sounds like a lot, but here's what most people miss. You don't need to get there from $50 a week alone.
This strategy works alongside other income, your job, a side hustle, maybe a spouse's income. Every dollar you add accelerates this. And even if you never fully replace your job, imagine having $1,000 a month in passive income. That changes everything. That's rent in some cities. That's the amount that lets you take a lower stress job, work fewer hours, say no to things that drain you. Financial freedom isn't always about quitting your job. Sometimes it's just having options. SCHD gives you options. How to actually start. All right, let's make this practical. Here's exactly how to set this up today. It takes about 10 minutes. Step 1, open a brokerage account. If you don't have one, Schwab and Fidelity are both excellent. They're free to open, no account minimums, no trading fees. Step 2, search for SCHD. Once your account is open and funded, just search the ticker SCHD. That's it, one ETF. Step 3, enable DIRP. This stands for Dividend Reinvestment Plan. It automatically takes every dividend you earn and buys more shares of SCHD. This is where the compounding magic happens. Without DIRP, you're leaving serious money on the table. Step 4, set up automatic weekly investments. Most brokerages let you automate this. Set $50 to transfer and invest every week automatically. The key is to make it automatic, so you never have to think about it and never accidentally spend that money. Step 5, don't touch it. This is the hardest step for most people. The market will drop. SCHD will go red some weeks. Leave it alone. Every dip is just buying more shares at a discount. That's the entire strategy. Open account, buy SCHD, enable DIRP, automate $50 a week, walk away. Now, let me answer the questions I know you're already asking. What if the market crashes? It will, multiple times over 30 years. SCHD dropped during COVID. It dropped in 2022. It recovered both times. In fact, during crashes, your $50 a week buys more shares at cheaper prices. Crashes are a feature, not a bug, when you're in the accumulation phase. What if SCHD cuts its dividend? SCHD's screening process is specifically designed to avoid this. It holds companies with strong cash flows and consistent dividend histories. Could it happen? In a severe enough recession, anything is possible, but SCHD's structure makes it far more resilient than picking individual dividend stocks. What if I can't afford $50 a week? Start with $25 or $10. The math scales perfectly. $25 a week for 30 years at 11% still builds to over $300,000. The amount matters less than the habit. Start with what you have. Increase it as your income grows. Isn't 11% return too optimistic? Fair question. SCHD's actual 10-year annualized return with dividends has been around 11 to 12%. I'm using the lower end. Even if you use a conservative 8% return, your 30-year outcome is still around $350,000, still generating over $1,000 in dividends. The math works under multiple scenarios. That's what makes this strategy so powerful. Here's the truth nobody talks about. The people who build real wealth aren't the ones who found some secret stock or timed the market perfectly. They're the ones who started simple, stayed consistent, and let time do the work. $50 a week, SCHD, DIRP on, automate it, forget it. That's the whole strategy. Now, I want to hear from you. Drop in the comments, how much are you starting with? $25? $50? $100? Let me know. I read every single comment. And if you want to see what happens when you combine SCHD with 2 other ETFs for even faster results, I broke that down in this video right here. Go watch that next. Don't forget to subscribe if you're new. I post practical investing content every week that actually helps you build wealth. I'll see you in the next one.